The Canadian banking regulator is flagging risks about the housing market, and they're also flagging risks to the financial system. The Bank of Canada is warning about problems with hedge funds borrowing in the repo market. We're going to get into all that. And Justin Trudeau, the biggest hypocrite in Canada, has come out and said that housing needs to retain its value. So this story was published last week, and it's just infuriating. I mean, this guy, to show you what a hypocrite he is, Stephen Punwazi heads up Better Dwelling, I believe, and he put out this, which is just some screen grabs of basically Trudeau saying the housing value needs to retain its value. Record high number of Canadians believe they'll never own a home, new survey finds. Canadians present a major threat if they realize they won't own a home. And Trudeau says home prices have climbed far too high. So Justin Trudeau, obviously massive hypocrite, but let's see what he's saying. So Prime Minister Justin Trudeau says his government aims to make housing more affordable for younger Canadians without bringing down home prices for existing homeowners. So what is that going to mean? That is going to essentially mean more debt. It's going to mean debt slavery. But the thing is, these central planners and politicians, they make the mistake of thinking that they're in control of these massive markets which are larger than the government. So the thing is, if the Canadian government believes, oh yeah, you know, we can control housing prices, I mean, they can to a certain extent, but there's massive trade-offs with doing so, which is you put your financial system in jeopardy, you put your financial system at risk, you put the banks at risk, or you put the government's finances at risk, which is in the case of what they've done in Canada. And I think it's absolutely infuriating that Justin Trudeau thinks that Canadians are this stupid and thinks that they are going to think, oh yeah, you know, that just makes total sense, and they're not going to be able to connect the dots and work out that he's essentially saying younger Canadians need to subsidize the wealth of older Canadians because we inflated their pensions away and they're worth nothing. They need their home equity in order to sustain themselves, and we want you, the young people, to get into debt to pay for that. And he just thinks that younger Canadians won't understand it, and I think that is so disrespectful. But bluntly, a lot of people won't understand this. A lot of people don't think critically, and they won't connect the dots. So that's the unfortunate reality. So anyway, cutting shelter costs while ensuring that homeowners' property values remain high could be viewed as contradictory. But Mr. Trudeau was adamant that property owners would not lose out. Housing needs to retain its value, Mr. Trudeau told the Globe and Mail's City Space podcast. It's a huge part of people's potential for retirement and future nest egg. And this is the problem because it's become a speculative asset in Canada. It's essentially destroyed the economy because so much capital has been absorbed by the non-productive housing market instead of going into creating new goods and services and businesses, pushing for regulatory red tape to be reduced to make the way for new businesses, to offer more competition for Canadians and bring down prices. But it's just unbelievable. I think it's just so disrespectful when you have politicians coming out and saying this, especially to the people he's supposedly trying to market himself towards. So many residents have been priced out of Canada's housing market, with typical home values topping $735,000 across the country and exceeding $1 million in Toronto. The cost of rent has also been climbing, increasing the frustration among younger voters that the Trudeau government is trying to appease. And here's another thing, guys, that you have to realize is the value of Canadian homes is almost fictional in a way because it is totally dependent on credit and leverage. Think about it this way. It's easier to put it into perspective by thinking of houses being valued in a completely separate currency. So when you go to buy a house in Canada, let's say you're buying it with housing Canadian dollars or debt Canadian dollars. So if a home is priced in debt Canadian dollars, is anybody actually paying cash for that home? No, the reality is 90% of the transactions that are going on out there are not cash. They are people with massive amounts of debt and loans. So those dollars have purely been created for housing, and basically those dollars being created have sent the money supply of these housing dollars or these debt dollars that has skyrocketed, which basically means that the home price prices skyrocket with it. The thing is, a lot of people get this mixed up. The government, yes, their deficits do impact inflation, but it's not as if the government directly drives up the cost of housing. That is actually the responsibility of the banks. The banks lending, creating credit. The more credit that the banks create, guess what? The higher the prices will go. If the government suddenly says, yeah, you can do 0 down payment now, and we're going to start doing ninja loans again, then guess what? That means more and more credit is going to be created. That means the lending conditions have gone down, more credit's being created, housing prices will go up. Now, obviously, that means future problems, but I'm just using that as an example because a lot of people get mixed up with that, and therefore the housing debt can actually be destroyed. You see, when it gets to a certain extent, people can't afford those loans. Anyway, kind of rambling here, so let's continue onwards. So Canada household credit market debt to disposable income is sky high, as we know, and he's saying that, yeah, we're going to keep housing prices high, and how's he going to deal with this? I mean, you can't send this to 300%. It's just completely unrealistic, and it's never even happened. It gets to a certain extent, and it just starts doing nothing, and then you get a blow off top, and it peaks out, and it's coming back down right now. So we've kind of reached the ceiling of the amount of debt that people can afford to have in Canada. So how on earth is it going to be possible in the future that they're going to be able to keep housing prices high? The only way it's possible is if they dilute the currency down enough and people's wages go up with that. The only way that they'd be able to orchestrate this is by essentially inflating the currency away. And then as the currency gets inflated away and there's lots and lots more inflation, the housing prices in real terms, as we've discussed many times, are in fact going down at that point. And then that basically means that people are losing out, but most of the homeowners don't even realize it. And then the prices in nominal terms retain their value, because you think about it, guys, Trudeau knows that most people don't even understand inflation. They don't understand that they're losing 2% per year at a bare minimum. And guess what? Pierre is exactly the same way, because he's always been saying you need to get that inflation back down to the 2% target. Well, it should actually be 0%. Why are you inflating the money at 2% per year? That's not really stable. When you add it up, it adds up and compounds to a lot of money being lost. And guess what? People's wages have not been going up and keeping up with that, because more and more, as you get into the later stages of these cycles, there's just more and more greed. The people with assets, with money, just hoard it more and more and more. And eventually that just leads to the collapse and demise of the whole bubble. So it's funny how these things are kind of self-inflicted. So bank regulator in Canada warns of housing payment shock by 2026. So Canada's banking watchdog warned that many homeowners who took out mortgages when rates were near zero during the pandemic will soon face a reckoning as those loans renew. The payment shock faced by some borrowers is among the most important risks currently in the financial system, according to the latest risk outlook from the OSFI released Wednesday. The regulator said that 76% of outstanding residential mortgages as of February will be coming up for renewal by the end of 2026. Most worrisome are the 15% of mortgages that have variable rates with fixed payments. Some of those loans are negatively amortizing and completely upside down. Let's remember that. The regular payments no longer cover the full interest costs because rates have gone up so quickly, so the principal balance is increasing. The principal balance is increasing on an asset where the value might actually be declining or have gone down substantially since they took out that mortgage. So just think about the risk. 15% of mortgages might sound like a small number, but you're talking about hundreds of billions of dollars in Canada. And to put that into perspective, guys, the loan loss provisions at Canadian banks are not even $1 billion at most of the banks. So you're talking about hundreds of billions of dollars of loans potentially that could be completely written off in the future because people can't afford to pay them. In fact, it's most likely that most of those are in distress right now. It's just the regulators, the banksters, the Bank of Canada. Nobody wants to take any action upon this. It's just like, oh, hopefully we're just going to leave things. Rates are going to come down. Somehow miraculously, these people are going to find $20,000, $30,000 and then they're going to be able to pay down their balance. It's just not going to happen. It is completely complete fantasy, yet this is what these banks are thinking and hoping that's going to happen in the future. And it's not just the banks. So it's very, very interesting that that is happening. And then you've got the same thing. Canadian banking regulator says real estate mortgages pose risk to financial system coming out of CBC. And then you've got Bank of Canada warns of systematic risk as hedge funds ramp up borrowing to profit from falling rates. So we're talking about a housing market posing systematic risks to the banking system. We're now talking about hedge funds. And this sounds so much like gilt market blow up in England back in 2022. For those of you that follow the channel, this is going to sound so familiar. It's like doing the same thing, expecting a different result. Shortly after the Bank of Canada released its latest financial stability report last week, Brian started getting calls from worried clients. They were concerned about a warning issued by the central bank about hedge funds and pension funds having significantly increased the amount of money they borrow through the repo market, essentially short-term loans that are backed generally by liquid assets like government bonds and things like that. So Canadian asset managers have increased their repo market borrowing, otherwise known as leverage, by 30% over the past year, according to the Bank of Canada data. For hedge funds, repo leverage is also up 75%. This has largely been to finance something called a cash futures basis trade, which seeks to profit from discrepancy between the price of bonds and futures contract at a time when interest rates are expected to move downward. Now, they are just speculating, guys, and we can also speculate because there is no evidence that that's the actual case of what's happening. What could be happening is these hedge funds are actually in trouble. They own a lot of these commercial real estate loans, all these commercial real estate derivative products. I mean, especially the pension funds. We know they have been exposed to commercial real estate. We've covered it in other videos. In fact, I'll link one at the end of this video. So they're just speculating about what's going on, but it could also be a sign of distress. But what actually could happen is kind of hilarious because it's exactly the same as what happened in the UK in 2022. The Bank of Canada's concern, however, relates to the potential for asset managers who are more complacent about utilizing a strategy that, if overused, could pose a systematic risk to the entire financial system. This is the Bank of Canada that's saying that, guys. So we've seen an increase in borrowing, particularly in repo markets of hedge funds. Bank of Canada Governor Tiff McClem said in May 9th press conference about the FSR, in the event that there was a sudden repricing, a sudden change in bond prices, a big change in yields, there could be a situation where either because of margin calls or need to unwind those trades, they could have to sell the bonds into a weak market, and that could really amplify the market swings. And guys, this is exactly what happened with the LDL situation in the UK back in 2022, which was lots of pension funds, hedge funds that had loaded up on a similar derivative product and a similar trade that then backfired when yields started to go up and led to yields that just exploded. And then the Bank of England had to actually intervene in that market. But the thing is, the currency really took a huge hit during that period. I mean, the pound absolutely crashed and it took like 6 to 8 months to recover after that. It really nosedived. I mean, I remember seeing how fast everything was moving and it was kind of concerning. And luckily in that instance, the Bank of England was able to come in and calm the market. And I'll just tell you that they did that while still increasing rates after that. So that doesn't mean that if something happens, the Bank of Canada is going to come in and start cutting rates. I mean, sure, they could use it as an excuse and as cover for sure. So it's very, very interesting. And then you've got the banking regulator orders TD Bank to overhaul risk controls. Canada's banking regulator has ordered Toronto Dominion Bank to repair the nerve center for its risk controls as the lender works to resolve money laundering investigations that have raised the ire of American officials and thwarted TD's plans for expansion in the United States. The OSFI identified deficiencies with TD's regulatory compliance management program during a recent assessment, according to two people familiar with the matter. TD, which reports its fiscal second quarter earnings on Thursday, is under increasing pressure to disclose details about the US probe into its anti-money laundering weaknesses. OSFI's review of TD's RCM program adds to the regulatory scrutiny of Canada's second largest bank, bank on both sides of the border. TD is taking an initial provision of US $450 million to cover financial penalties that it faces because of probes by 3 regulators and law enforcement in the US. Those investigations are tied to a US $653 million money laundering and drug trafficking case, the Globe confirmed. And you know, TD Bank's stock as well is down quite a lot from the highs and is one of the worst performing Canadian banks. It's down around 30% since the February 2022 high. So Toronto Dominion Bank's stock has took a hit as well because of all these issues with money laundering. And obviously Canada is known for money laundering. I mean, it even has a nickname, snow watching. So, and apparently TD is the center of this. The US has been concerned about this for a long time, and now regulators in Canada are finally catching up to it. And you know, we've seen so much of this laundering that has gone on and been well documented by people like Sam Cooper in his book Willful Blindness that I've recommended many times. It's just one of the most interesting reads about the situation in Canada and how it gets so far into government as well is just unbelievable. So anyway, guys, if you've enjoyed this video, I would highly recommend that you check out this video here. This is the video about pension funds. If you're looking for a VPN to get around any of the censorship in Canada, go to expressvpn.com/marketmania. That's the VPN I use. I will see you